In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25%.
The Federal Reserve announced it is pausing its interest hikes, showing officials believe they are having success in bringing down inflation. After a two-day meeting of its Monetary Policy Committee in Washington, D.C., the central bank announced it would not be increasing its interest rate target. The decision is in line with the vast majority of economists and investors who anticipated a pause as the pace of inflation continues to slow. But rates are still the highest they have been since 2007, at the outset of the global financial crisis. And the move to pause doesn't mean the U.S. economy is completely out of the woods against the backdrop of elevated recession odds.
Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go.
But the pause is a signal the central bank is beginning to see an economic slowdown as potentially more problematic than too high inflation. It also indicates the Fed is growing more confident in the signs inflation is meaningfully slowing, crediting the rate hike pause in large part to the still thriving labor market.
The labor market, I think, has surprised many, if not all, analysts over the last couple of years with its extraordinary resilience, really. It's just remarkable, and that's really, if you think about it, that's what's driving it.
In May, inflation fell to a 1.1% annual rate, a good sign for consumers who will feel the drop in prices for everyday goods.
We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks.